This is our fourth lecture. It's on financial statements. We're going to break this lecture up into two parts. First part will basically be a review of the financial statements, which you've probably seen balance sheets and income statements before in an accounting class, or if you've ever done any serious book work or anything like that. So just real quick, we'll review, make sure we understand what all the different the balance sheet, income statement, things like that are. And then the second part, we'll do financial statement analysis, where we turn the raw numbers of the financial statements into some ratios so that they're comparable over time and across companies, things like that. So for starters, each quarter, 4 times a year, every public corporation has to issue a report, an annual report once a year, but then the other 3 years is called a quarterly report. But these reports have a lot of information in them. A big chunk of it's what we call the verbal or narrative section, where it talks about what kind of business that firm is in, how the last year went, or the last quarter, depending on what kind of report it is, where they think the business is going in the future, things like that. But then it also contains their financial statements. So even if you're not a public company, you would keep your own financial statements. But if you are a public company where you have publicly issued stock that anybody can own, you're legally required to 4 times a year release your financial statements so that your investors know how you're doing. Let's look at one of these annual reports. I have one here for Coca-Cola. This last year, 2011. They haven't issued their 2012 one yet. A whole bunch of information in this annual report. We're not going to go through it all, but so it talks about their business, what they're in, what their risks are, what kind of things they own. It has a big long management discussion in here, where management writes up again how the firm did one year to the next and how they're going to do the next year. And then here's item 8. It's always item 8. We'll click on that. This is where it gets into the financial statements, which is what we're talking about here. So the first thing that comes up is the income statement. Let's talk about what an income statement is. So I'm going to switch over to this. I have sort of a summarized income statement here. Income statement gives how much money the firm brought in and paid out as expenses, and then the bottom line, how much money they made over the last period. So it's over a period of time. If it's an annual statement, it's over the last year. If it's a quarterly statement, it's over the last 3 months. So for starters, I gave this really simple version. It's revenues minus expenses equals net income. Revenues is all the dollars they brought in from sales. The revenue, sales, same thing. So if you're a candy bar maker, every time you make a candy bar and you sell it for $1, you count $1 as revenue. If you're Coca-Cola, every time you sell a Coke for $1, you count $1. But you also have expenses, also obviously. So you don't get to keep all that dollar. A lot of that goes to pay your employees, your suppliers, all that stuff. Once you take all those expenses out that you had to pay to make the candy bar or the Coke, whatever business you're in, whatever's left over at the end is called your net income. That's how much profit you made. Net income, profit, same thing. So that's the real simple version. Here's a little bit expanded out. If the typical income statement will have many more categories than just revenues and expenses. Revenues is still what we call the top line. They can break that out if they want. In fact, it could be much more complicated than this. This is still a fairly simple income statement. But we call our top line revenues. That's our sales. Sometimes they'll break that down into different types of sales, but a lot of times it'll just be revenues as your top line. Usually the first expense they'll take out is called cost of goods sold. Cost of goods sold is, well, it's inventory that's been expensed off, but in common sense terms, it's direct expenses that went into making the product. So if this is Coca-Cola and we're selling sugar water, it's the sugar and the water and the labor that went in to build those cans of Coke and sell the cans of Coke and all that kind of stuff. After you take that direct expenses out that are direct material and labor that was used to build the product, we have what's called gross profit. We have our gross profit that's available to us to pay all our other expenses, so all our other overhead. That other overhead fits into this sort of other operating expenses. So there's things like selling, general, and administrative. So selling is advertisement. When you Coke has a lot of advertising expense, for example. you can't really tie that down to one specific can of Coke, because if they go out and run an ad during the Super Bowl or something, we don't really know which cans of Coke that helped sell. And so it doesn't fit into cost of goods sold, but it's obviously still an expense. So it fits down under this selling general administrative. And then general administrative is obviously overhead as well. Research and development usually fits under there as well. If Coca-Cola goes out and does marketing research and to try to figure out a better tasting soda pop that people want to buy more, you can't really tie that down to any one can of Coke, but that's an expense. Depreciation, amortization, that has to do with writing off capital expenditures. We don't need to talk more about that. Once you take all those operating expenses out, you get what's called operating income. The only thing that's left is interest and taxes. Interest is what you pay on your debt. Taxes are what you pay to the government. And then you get your net income. So let's go back real quick and look at Cokes. It should follow that same format. So right on top you have net operating revenues. Lots of details in here I didn't touch on that we don't. Every income statement you look at will look a little different. So if I pulled up Pepsi's, it'll look pretty similar, but if I pulled up ExxonMobil's or something, it might look a little bit different, but they all follow kind of the same format. But there's little eccentricity, or I forget the word, but there's little bits of differences between different companies, like net operating revenues. That word net is on there just because they sell a lot of stuff on credit, and they have to account for the fact that a lot of their credit sales are never going to get paid off, and so they put that net on there. But it's beyond the scope of the class. We don't really need to worry about that. But basically, they're starting with revenues at the top. They take out cost of goods sold, get their gross profit. Then they have those other operating expenses like selling, general, administrative. They get their operating income, then they take out interest, and they take out taxes, and finally they get their net income. A couple other little minor accounts in there that we don't need to worry about. They also break it down into a per share net income down here. So this is basic net income per share. We'll deal with that when we get to the financial ratios, but since their stock sells per share, it's nice to know how much they're making per share. So you just divide by, this is per the whole company, right? So their net income, let's look what it was real quick. About 8.5 billion. You'd like to know, all right, if I'm going to buy one share of stock, how much am I getting? Because you're not going to get the whole 8.5 billion, right? So you divide it by the number of shares outstanding, and you get the net income per share. All right, now let's scroll down. The next thing that comes up is the balance sheet. Income statement and the balance sheet are the two most important financial statements. That's what we will use the most. There's two others, which we'll get to in a second, but balance sheet's the other really important one. Let me flip back over here. I have sort of a simplified balance sheet. So for starters, the basic accounting equation is assets equals liabilities plus equity. That has to do with the left-hand side is assets, the right-hand side is liabilities and equity, and those two have to equal out. The reason being, assets is everything you own, liabilities and equity side is where you got the money to buy all that stuff. So you had to raise all the money somewhere that you spent somewhere. If we break assets down into their basic categories, and then again I have a little more complicated, but let's start with a simple one. We'd break it down by current assets and non-current assets or fixed assets. Current assets are assets that will be either already are cash or will become cash within a year. So they're liquid assets. Assets that are close to being cash, meaning spendable money. Take, for example, real estate is not a liquid asset. It would not be a current asset. However, a 3-month treasury bill, that's a debt instrument the government issues, will mature in 3 months, and then you'll get the cash back, and then so that is a current asset. Everything that's not a current asset we'll call fixed assets. There's also a current liability, and that's any debt that you owe that you have to pay in the next year. The rule for the currents is you have to, if they either come due in a year or you have to pay them in a year, they're called current. Anything that's not due in a year that you've borrowed is a long-term liability. And then equity is anything you didn't borrow, but it's ownership. It's the money that the owners put into the firm. Let's break it down a little more complicated. So for current assets, there's different things that could be in there, and this is, again, this is not a full list. This is just this is still a fairly simple. It's just a little more complicated than the one we started with. But for example, cash and equivalents fits under current assets because it's cash already. Accounts receivable is a very common one. That's stuff they sold on credit, so their customers didn't actually pay them. They have to pay them in the future. That's called an account receivable. That's usually going to be paid within a year, and so we count it as a current asset. And then inventory. Any kind of inventory that they've started to build a product but haven't sold it yet, probably get to sell it within a year. Almost all businesses, when they start building a product to the time they sell, it's within a year. There's a couple types of businesses that might not be true if you're building skyscrapers or something, but for most businesses that's true, so it's a current asset. Once we get into the fixed assets, there's long-term investments. Anything that you've invested in that's not going to mature within a year, it's long-term. Property, plant, and equipment's all your physical assets, your buildings and stuff, your plant that you use to build your product. And then there's intangible assets. There's lots of different things. To be intangible, it means it's not really an investment per se. It's things like, so for Coca-Cola it would be trademarks and things like that. So they have the brand and trademarks. Those are sort of intangible things, but they do have value. They might have paid for them. So they might have gone out and bought, say, a brand name of a soda pop that another company owned, and they paid money for it, and that money that they paid was an investment, and so it goes on here as an intangible asset. It could also be things like goodwill. So if they buy a whole other company and they paid more than what we call the book value of the company, that becomes an intangible asset. So things like that we put down at the bottom because intangible is sort of the hardest to define when it matures, kind of, I don't know. It's just the accounting rule. All right, over here on the liability equity side, there's different types of current liabilities. Just like there's accounts receivable, there's accounts payable. Receivables are credit sales you made. Accounts payable is when you bought something from your supplier and you didn't pay right away. You have to pay maybe in a month. That's very standard. So you might have 30 days to pay, and then in the meantime it's an account payable. It's a liability. You have to pay it because they already gave you the goods to make your product, but you haven't paid them yet, so it's a liability. It's sort of like borrowed money. Accruals just refers to, and there's those on both sides actually, that's things like wages that you owe people but you haven't paid them yet. Or maybe you owe a utility bill and you haven't actually paid it yet. Short-term debt is short-term borrowing. So you might have borrowed a 3-month loan, or you might have borrowed a 10-year loan and it's 9 years later, and so it comes due within the next year. It becomes a current liability. Long-term liabilities are like bonds, long-term debt, things like that. And then equity, it's really two types of equity. There's money you raised by issuing stock, and then there's retained earnings. All right, if we go back to Coke, we'll basically see the same format, and we need to hurry up because we're running up on our 15-minute time limit here on these lectures with the software. So yeah, they have current assets, which is everything we said, cash, receivables, inventories, and some accruals here. They have some long-term assets, property, plant, and equipment, and then they have trademarks and goodwill and all these intangibles. Under liabilities, they have current liabilities, long-term debt, and then they have all this equity stuff. Retained earnings is money that they've made and kept in the company. And then common stock, there's actually two accounts for common stock. That's they issued stock, an IPO, like we talked about in the previous lecture, and that's called stock at par value. Plus you have to, well, stock technically has a par value. It's a little confusing. We don't really, if you add together stock at par and capital surplus, that's how much money they raised by issuing stock. Okay. The other two statements we don't care as much about in this class. We just won't use them that much. But there's the statement of cash flow, which just reconciles net income to how much cash the firm actually earned. It's broken into three categories: operating activities, investing activities, and financing activities. You can go through each one of those and they basically make sense. For example, in investing activities, it's how many investments they bought, financing how much money they raised in different ways. Then the last statement is called the statement of shareholders' equity, and this is a real simple statement. It's basically this formula here. It shows your previous retained earnings. You add in all the extra money you made, and then subtract out what you paid out as dividends.